Hey everyone, welcome back. Today we are answering one of the most common personal finance questions out there. How much of your income should you actually be saving each month? It sounds like a simple question, but the honest answer is a little more nuanced than most people expect. There is a quick rule of thumb, and then there is a deeper, more personalized way to figure it out. We are going to cover both today. So whether you want a fast answer or a real framework you can actually apply to your own life, you are in the right place. Let's get into it. Let's start with the quick answer because sometimes that is all you need. The general rule is that you should be saving a minimum of 20% of your income every month. Of that 20%, roughly 10 to 15% should be going toward retirement accounts like a 401k or an IRA. The remaining 5 to 10% should be split between building an emergency fund, saving for other long-term goals, and paying down debt. That is the 50-30-20 rule applied to saving. 50% of your income goes to needs, 30% to wants, and 20% to saving and debt payoff. If you are not hitting 20% yet, that is your target to work toward. Even if you are nowhere near it right now, knowing the benchmark is useful because it gives you something concrete to aim for. But here is where it gets more interesting. That 20% rule is a useful starting point, but it does not account for your specific life, your specific goals, or the specific things you are trying to accomplish with your money. To really figure out how much you should be saving, you need to think about your financial goals, and those goals tend to fall into three categories based on timing. The first category is short-term goals, meaning things you need money for within the next year or so. This includes things like a vacation you are planning, holiday gifts, a birthday celebration, making sure you have enough set aside to cover your tax bill, or building up an emergency fund. That last one is particularly important. Having 6 months of living expenses saved in an emergency fund is one of the foundational moves of personal finance, and for a lot of people, it is something they can actually accomplish within a year if they are intentional about it. The way to approach this is simple. Figure out how much you need and divide by the number of months you have to save it. If you want $5,000 saved in 9 months, you need to be setting aside roughly $555 a month toward that goal. That math is straightforward, but it requires you to actually sit down and do it. The second category is medium-term goals. Things that are more than a year away, but less than a decade. This is where things like replacing appliances, making significant home repairs, buying a car with cash instead of financing it, or saving for a down payment on a house all live. These are bigger goals that take longer to build toward, which is exactly why they need to be planned for now. If you just hope the money will be there when you need it, it almost certainly will not be. The same math applies here. Figure out the target amount, figure out your timeline, and divide to get your monthly savings number. The third category is long-term goals, anything a decade or more away. This is where college savings for your kids, a second property, or any other major future expense lives. And of course, the biggest long-term goal for most people is retirement. Retirement gets its own category because it is both the most important long-term goal and the one that is easiest to put off thinking about because it feels so far away. But the earlier you start, the less you have to contribute each month to reach the same destination, thanks to the power of compound growth. So while retirement deserves its own conversation, the key takeaway here is that it should absolutely be part of your monthly savings plan. Now, here is the exercise that puts all of this together, and it is one that is worth actually doing, not just thinking about. Sit down and make a list of every financial goal you have, every trip, every big purchase, every life event you are planning or expecting, plus your retirement and emergency fund. For each one, write down how much you need and when you need it by. Then do the math. Divide the amount by the number of months you have. Add up all of those monthly numbers. The total is how much you should ideally be saving each month across all of your goals combined. And here's the part that surprises most people when they do this exercise for the first time. The number is usually bigger than what they can actually save. That is not a failure. That is just reality, and it is useful information, because once you know the gap, you can start making decisions about how to close it. There are a few ways to handle it when your savings goals are bigger than your income allows. The first is to adjust the goals themselves. Can you buy a less expensive car and pay cash for it instead of financing something out of your budget? Can you have a smaller wedding? Can you look at a more affordable home that requires a smaller down payment? Scaling back a goal is not giving up on it. It is making it actually achievable. The second approach is to cut your current spending to free up more money for saving. Canceling a streaming service or two, reducing your dining out budget, or finding a cheaper phone plan can each release $50 or $100 a month that can go straight toward your goals. The third approach is to extend your timelines. Does that kitchen renovation absolutely have to happen this year, or can you push it back and buy yourself more time to save for it properly? And finally, the fourth approach is to earn more. A side freelance project, a part-time gig, or eventually a higher-paying job can all increase the amount you have available to save each month. So to bring it all together, if you want a fast answer, save at least 20% of your income, with the majority going toward retirement. If you want the right answer for your specific situation, spend 30 minutes writing out your goals, running the math on each one, and building a savings plan around the actual numbers. It is not the most exciting way to spend half an hour, but it is one of the highest value things you can do for your financial future. The people who know exactly what they are saving for and exactly how much they need each month are the ones who actually hit their goals. Everyone else is just hoping it works out. Thanks for watching. Drop a like if this was helpful and let me know in the comments how close you are to that 20% target. I will see you in the next one.